Securitization for FRM Part 2. This is an audio class and I will be talking about credit enhancements. So there are basically two types of credit enhancements that could be done, and first is the internal credit enhancement and second is the external credit enhancement. So distribution of credit risk is the most important part whenever we are structuring a securitized issue. For example, subordinated classes of securitized will bear a disproportionate share of the credit risk, which means that those who are at the bottom will face more credit risk. However, the wide variety of assets securitized, particular risk tolerance of investor, desired credit rating and other factors also create a need to allocate the credit risk. So we are basically playing around with the credit risk here, and we can increase or decrease them depending on how we place that, how we do the securitization process. The first part here is the internal credit enhancement, which is an additional protection provided internally to the securitization structure. The most common type of enhancement here in the internal type is the over collateralization, where more assets are pledged to back the security and access the liabilities. So imagine a mortgage pool that has like 1000 mortgage, but the originator included like 1100 mortgage. So this is a case of over collateralization by around 100 mortgage, which means that the investor can absorb one by one up to 100 defaults suffering from an economic loss. There are other internal credit enhancements like direct equity issue, holdback, cash collateral account and excess spread. Now direct equity issue. The SPV issues debt with a face value less than the collateralized in the pool. The difference could be made up by issuance equity. However, the demand for such slices of asset pool is small. The originator needs to retain a small portion of the equity, but this equity may violate the independence need for transference to SPV. So if the investor or the originator and the originator takes out some part of this equity or the riskier part, then this does not account for the transfer of SPV rules that we just talked about. Then we have the holdback. If the SPV pays fair value of the assets in the pool, there is no over collateralization. However, if the SPV pays less than fair value of the assets, this is an effectively over collateralization. So if the SPV pays fair value of the assets in the pool, there is no over collateralization. Then we have the cash collateral account. The cash collateral account is reserve, not unlike an escrow account set aside by originator to cover losses in the pool. Of course, if there are no losses in the pool, the originator would want this reserves returned. However, the CCA runs into similar problem as the direct equity issuance method. In the originator is tied to the performance of the asset it sold, the transaction may not qualify for a true sale. So this is again a cash collateral account where he will give some collateral, but he will absorb collateral back if there is no loss. So this would disqualify as a true sale. Excess spread. An alternative method to the over collateralization is to generate a positive excess spread between collateral assets and liabilities, coupon of the SPV, less fees and expenses. The process is similar to depositing institution funding loans with lower cost deposit. The excess spread can accumulate in a CCA or a cash collateral account and can even accrue to equity holders after the SPV debt matures. So virtually taking out a loan and keeping that cash to absorb the loss or something like that. So these were the internal credit enhancement. The external credit enhancement involve explicit credit risk transfer to an outside party. The four that we talk here would be like issuance, reps, guarantees, letter of credit, credit default swap and put options on the asset. Issuance, reps and guarantees. If the SPV effectively purchases protection for senior bondholder with an insurance policy or a guarantee where the deductible is the amount allocated to the subordinate investor, in this case any losses that affect the senior holders can be recovered via the insurance policy. So simple enough. Letter of credit. The SPV obtains a letter of credit for a senior dollar amount If the losses surpasses the subordinated threshold, the credit line is drawn down to maximize of the full senior debt level. So that's a letter of credit. Credit default swap. Structuring a credit default swap on a full portfolio with a deductible set of subordinated debt will accomplish the necessary credit enhancement. Put option on assets. The put option allows the SPE to sell the collateral assets to put writer for a predetermined price. The put strike is set at a loss level of the subordinate range. Then the loss would be accrued to the senior holder, that is the larger than the junior claims are offset by the gains in the put position. So these are some of the credit enhancement that you are going to see.